Let's start with this. Look, we come at the end of a sort of record week for issuance. I think the week before was record. It was a record March. We've had a record April. Probably May, similarly, is going to be a blowout month. Has the Fed actually just backstopped the market or really put it on steroids here?
Well, it would not be an exaggeration to say that we are clearly firing on all cylinders. In fact, just shy of $90 billion to close out this week, which is the third most active week in the IG markets, as you referenced. But to put that into context, that's akin to the type of volumes that we would traditionally have priced over the course of an entire month in pre-COVID era markets, and in fact ahead of the Fed backstop. But it also solidifies April's $295 billion tally as sort of a new all-time high, second only to March of this year, which is effectively topping an astounding $500 billion in new investment-grade debt issuance since this uptick in vol began. And I think, as you rightly point out, much of that normalization in our markets we attribute to the Fed, and I think it's central banks, both the pace and orderliness of the stabilization we're seeing, a timely but visibly swift introduction of both primary and secondary corporate credit facilities that have helped with risk management and eased, I think, fears as we thought about potential refinancing risks or economic implications as a function of COVID.
But they're yet to buy a single bond. I mean, the Fed have said, yeah, they have $750 billion to throw at the problem, but so far they haven't had to spend a dime.
It's true. I think that the existence of the program alone, but particularly the inclusion of fallen angels and high-yield ETFs, which was in the second iteration that they released on April 9th, has done enough to sort of re-imbibe confidence into the market and I think specifically addressed front-end dislocations that we had been seeing in the nascent stages of the volatility and alleviating, at least for now, any potential indigestion that might have ensued in the wake of this outsized spring supply. So I think that, yeah.
Another factor, Meghan, that we've seen is this huge compression in terms of the spreads just over the last few weeks, really since the Fed actually intervened in the market. How much of the activity you're seeing now is by companies who have already issued going into March and are actually just refining to take advantage of that compression?
Well, you touch on exactly the right point. IG spreads have retraced more than 90% of the widening that we peaked in late March, with the credit index a full 150 basis points tighter over that period of time. So significant wealth generation for the buy side, which is helping to support this calendar and helping us to throw out the historic playbook where we're getting an onset or an uptick in terms of repeat issuance. Just this week, seeing transactions from Coca-Cola, Pepsi, and Mondelez following the lead taken by Exxon and others to come back to market to take advantage of significantly reduced all-in costs of financing.
Have you got any sense as to when the Fed is going to actually start buying some of these bonds?
Well, there's certainly speculation that they're contemplating something in the near term, and I think still hammering out a number of details. But, I think at the end of the day, $750 billion of buying power, an effective backstop of the entirety of the market, has not only eliminated significant refi risk, but it's affording corporations flexibility to weather this pronounced economic slowdown.
What happens when they take it away or when they begin to take it away?
Well, the question there boils down to some of the details that remain a bit opaque. We've seen similar measures being employed in Europe, with the ECB having been involved in purchase programs out even to 31-year maturities. The Fed is focused 5 years and in. The question is, how opaque is their participation? Do we have transparency in terms of which specific credits are benefiting from that bid or participating in the programs? And in the unwind, does that become readily visible to the market? I think they're attempting to do this in an orderly fashion. They've hired counterparties to act on their behalf, and my expectation is they're going to be discrete in terms of that activity. So you might see headline volumes tick up on their balance sheet, but ultimately, which specific credits have benefited, I think will be something, on a private side of the wall in terms of those who've obtained access.
Meghan, just to close us out here, looking at the market with all of these incentives, with the, as I said, steroids that the Fed have sort of injected into it, do you think we're going to hit $1 trillion this year in issuance?
I'd hate to say we're spitting distance of that looking at volumes as we move out of corporate earnings blackouts here. May is expected to mirror the volumes that we saw in March and April. If that's the case, we're going to be talking within $350 billion or so of full year 2019 figures, less than halfway through the year. So I think it's likely we surpass that trillion mark well in advance of anyone's expectations.